Many accounting firms are simply unsellable, and unfortunately many owners and partners realize this too late. So we're going to take a look at two possible exit strategies. There's a few more, but today we're just going to focus on just two. So option A is to make partner at your accounting firm. You get paid with a multiple of your salary over typically 10 to 15 years, and that's without interest and tax as ordinary income. Now let's take a look at option B. Option B is a bit more non-traditional, and that involves private equity. So the idea is to become a partner at your firm, get backed by private equity, and get an immediate payout, which will allow you to get a rather lucrative exit in about 3 to 7 years. The firm benefits from PE capital by being able to expand capabilities and to scale a lot more rapidly. So instead of waiting until retirement, you actually get to access a lot more capital in the early days of your career. Now, lately I've seen a massive amount of private equity money flowing into accounting firms. I talked about that the other day on my LinkedIn post, but it's happening a lot more quickly now. But what's happened more recently is that large private equity groups are waking up to the fact that accounting is a highly fragmented $150 billion industry that is just ripe for consolidation. And this actually uses a playbook from IT managed services providers and how they get acquired. In this case, the private equity groups are looking to build national platform accounting firms that are essentially acquiring smaller firms. And the barrier to entry is getting a lot smaller. PE firms are looking at firms with several million in revenue, and acquisition-oriented accounting firms even as low as $500,000 to $1 million. And this creates tremendous optionality for smaller firms who are actually open to private equity investment or acquisition. And the beauty of this is that PE firms can provide large capital infusions to really help smaller firms scale rapidly, and at the same time they're allowing them to use this capital for large technology upgrades, AI, automation, things of that nature, RPA. So a firm can really modernize with this infusion of cash and invest in the automation, the AI, even offshoring to remain really competitive in the face of declining compliance revenue. And to look at the higher end of things, PE firms are incentivized to help firms expand rapidly into higher margin advisory services to rapidly fuel growth. And the interesting thing about this is that modern PE firms are really changing the game by moving away from the slow retirement buyout model to more of an immediate payout and equity participation that can actually help yield bigger paydays in just 3 to 7 years when the private equity firm looks to sell your now grown firm. And this is really an interesting playbook because the shift is really helping PE-backed firms attract top young talent away from even the biggest accounting firms. And this is really the difference between exiting a firm at a sub 1x multiple versus a 2x plus multiple. So this is really the early days, and it's the convergence of AI, automation, offshoring, and other novel business models. And I think the firms who really get this are indeed the firms of the future.